In the heart of Manhattan's financial district, where billion-dollar trades flash across screens in milliseconds. A single transaction for 38 cents slipped through the system unnoticed on a rainy Tuesday morning. This was on a rounding error, or a glitch. It was a deliberate loan approved by an automated system that had never been designed to handle amounts smaller than $1. The algorithm processed it without hesitation, routing it through settlement channels built for corporate mergers and sovereign debt, treating 38 cents with the same bureaucratic gravity as $38 million. No human saw it. No trader flagged it. The system simply absorbed this microscopic anomaly into its vast machinery and moved on, unaware that this tiny transaction had just exposed a fundamental fragility in the architecture of modern finance, fragility hidden not in the complex algorithms themselves, but in the human decisions that built them decades ago when pennies still mattered. The story begins not on Wall Street, but in a quiet suburb where Maria Rodriguez, a retired schoolteacher, decided to invest her first dollar. After decades of watching her husband manage their modest savings, she finally opened an investment account on a popular app that promised to make finance accessible to everyone. The interface was sleek, the promises simple: start with any amount. So she entered 38 cents, the exact change left from her morning coffee, and tapped invest. The app accepted it without question, converting her pennies into a fractional share of a major index fund. What Maria didn't know was that her 38 cents would travel through a labyrinth of financial infrastructure never designed for such small sums. From her phone to a payment processor, then to a brokerage's clearing system, onward to the depository trust company, and finally to the actual market makers who had to physically account for this microscopic position in ledgers built for whole shares. Each step added friction, cost, and complexity that the system absorbed silently until it couldn't. For 3 days, Maria's 38-cent position existed peacefully in the digital ether. Then came the quarterly dividend payment, a few pennies credited to her account. The system attempted to process this dividend, but the math broke down. 38 cents invested in an index fund entitled her to a dividend of approximately $0.0003. The clearing system, built in the 1970s when such precision was unnecessary, rounded this amount down to zero. But the audit trail remained. A transaction existed with no corresponding value. The discrepancy was microscopic, less than the cost of processing it, but it triggered reconciliation protocols designed to catch billion-dollar frauds. Suddenly, human beings had to intervene. Back-office clerks in New Jersey spent hours tracing a phantom 38-cent position through systems that had never been stress-tested for microtransactions. One clerk later admitted she'd never seen a position smaller than $500 in her 20-year career. Yet here it was, proof that the financial system's greatest vulnerability was unsophisticated hacking or market manipulation. It was the humble penny. Resurrected by technology and ignored by infrastructure. This wasn't an isolated incident. Across America that same quarter, over 17,000 investors made similar micro-investments, 30-2 cents here, 41 cents there, each one a tiny crack in the foundation. Collectively, these positions represented less than $4,000 in actual value. But they generated over $200,000 in processing costs as the system struggled to account for them. Settlement failures spiked by 23% in accounts holding positions under $1. Brokerages quietly began imposing minimum investment thresholds again, reversing years of democratization promises. The industry's response revealed an uncomfortable truth. Wall Street had spent decades building infrastructure for institutional players, then hastily bolted on consumer-facing apps without rebuilding the underlying machinery. The system could display fractional shares beautifully on a smartphone screen, but behind the scenes it was still running on logic designed for an era when the smallest tradable unit was one whole share of stock, a relic from 1971 when the New York Stock Exchange first allowed odd-lot trading. What makes this story profoundly human is not the technology failure, but the quiet dignity of people like Maria who believed the promise. She wasn't trying to game the system or exploit loopholes. She was testing whether finance truly belonged to ordinary people. Her 38 cents was an act of faith in a world that constantly tells small investors they don't matter. When the system failed to honor even this microscopic gesture of participation, it sent a silent message. Some amounts are too small to count. Yet Maria persisted. She added another $1 the next week, then $5 the week after. Her portfolio remained under $20 for months, but she kept investing not because she expected riches, but because she refused to accept that her participation required a minimum threshold of worthiness. In her persistence lived a quiet rebellion against a financial culture that measures human value in account balances. The deeper truth exposed by these microtransactions is unteed about technical debt or outdated systems, about who we decide matters in our economic architecture. For 40 years, finance optimized for speed and scale, building rails that could move trillions in seconds while quietly deeming small amounts unworthy of attention. The infrastructure reflects our values. We built beautiful highways for capital, but left dirt paths for participation. When apps promised to invest any amount, they revealed not technological limitation, but moral imagination failure. We had the engineering capability to handle pennies all along. We simply never prioritized it because pennies belonged to people we'd been trained to ignore. The 38-cent loan didn't break the market's mathematics. It broke its assumptions about whose money deserves respect. And in that fracture appeared a choice: rebuild the machinery to honor microscopic participation, or retreat to minimums that protect efficiency at the cost of inclusion. Today, quietly and without fanfare, the industry is changing. New settlement systems now handle sub-cent precision. Brokerages have rewritten reconciliation protocols to batch microtransactions efficiently. The cost to process Maria's 38 cents has fallen from $14.73 to 3 cents. But the real transformation is cultural, a growing recognition that financial dignity is unmeasured in portfolio size, but in whether the system acknowledges your existence at all. The most successful modern platforms now design infrastructure first for the smallest user, not as charity, but as engineering discipline. They understand that systems built to honor pennies naturally scale to handle billions. But systems built only for billions will always fail pennies. This reversal of design philosophy from elite first to human first represents the most significant shift in finance since decimalization in 2001, yet it happened not through regulation or revolution, but through the quiet insistence of thousands of Marias investing their coffee change. So the next time you see a penny on the sidewalk, consider what it represents, not as currency, but as concept. That copper disc embodies a radical idea that value exists independent of scale. A system that can honor 1 cent with the same integrity it grants $1 million is just technically sophisticated as morally coherent. The financial market's greatest untold story isn't about crashes or bubbles. It's about the slow, patient work of building infrastructure that refuses to discard the small. Because when we design systems that respect microscopic participation, we create something more valuable than efficiency. We create belonging. And in an age of algorithmic alienation, belonging may be the rarest asset of all. This story isn't really about 38 cents. It's about the quiet courage required to participate when the world implies you're too small to matter. Maria still invests her coffee change every Tuesday morning. Her portfolio has grown to $347.82, not life-changing money, but meaningful participation. She receives dividend payments now without system errors. The machinery learned to see her. And in that simple fact lies finance's most profound possibility. Not that markets will make us rich, but that they might finally learn to see us all, pennies and billions alike, equally worthy of respect. The market didn't break that Tuesday morning. It revealed its capacity to heal when confronted with the dignity of small things.